In the previous video, we looked at the income statement to test if it is good or not. But there's more to a business than its profits. Can the company pay its short-term debts? Is it drowning in debt? Is it able to operate efficiently? Let's analyze the balance sheet to uncover liquidity, solvency, and efficiency. The first balance sheet angle we'll look into is liquidity. This answers the question, can the company pay short-term debts on time? These are ratios that can help an investor analyze if the company has the ability to pay for its short-term debts on time, and to what degree. But before that, let's review what short-term debts are. Short-term debts are obligations of the company that are due within 12 months. They are debts that needs to be paid soon, thus availability of cash is crucial. The three basic ratios are current ratio, quick ratio, and cash ratio. The difference between these three is the intensity of the liquidity test. Current ratio is the normal test of liquidity. Quick ratio takes the test up a notch, while cash ratio is the strictest test. Here's what that means. In current ratio, we are testing if current assets are enough to pay for current liabilities. This is the most commonly used liquidity test. In quick ratio, we are only taking the assets that can be quickly turned to cash, excluding the less liquid components of current assets like inventories and prepayments, and testing it against current liabilities, making this the true test of liquidity. And in cash ratio, we are only taking the most liquid assets, which is cash and cash equivalents, and testing it against current liabilities. Therefore, cash ratio is the strictest test of liquidity. A ratio of 1 means 1 peso of current liability is covered by 1 peso of current asset. But is this good enough? The rule of thumb is, a ratio above 1 is ideal, because this means the company has some breathing room. A ratio below 1 is risky and could signal possible cash distress, while a very high ratio could point to an inefficient use of current assets. However, the stricter the liquidity test we use, the lower the ratio will be. So this rule may not be applicable all the time. Naturally, quick ratio is going to be lower than current ratio, and cash ratio will have the lowest result. Let's compute. Formula for current ratio is current assets divided by current liabilities. Our sample company's current ratio in 2024 is 1.7 times. This means that 1 peso short-term debt is covered by 1.7 peso of current assets. Is this good? It's above 1, so it is. But how does it compare to its competitors? Let's see. Its first competitor's current ratio in 2024 is 1.1 times, while its second competitor has 1.6 times current ratio. This means our sample company and its second competitor have ideal current ratios, while the first competitor might require a further look to understand why its ratio is lower by comparison, and why it dropped from 2023. The next test of liquidity is quick ratio. The formula is quick assets divided by current liabilities. Quick assets are current assets excluding inventory and prepayments. This tests the company's liquidity without the need to sell inventory. Our sample company's quick ratio in 2024 is 0.5 times. But it's below the ideal ratio, so is this bad? Let's check. First, we will look at the past to see how it performed historically, and for conviction, we are adding another year. We can see that this ratio level seems to be normal for this company. The next check is against its competitors. The first competitor's 2024 quick ratio is 0.6 times, and its second competitor is also 0.6 times. By making this comparison, we can see that this ratio level seems to be normal for this industry group, even though it is below 1. The last and strictest liquidity test is cash ratio. The formula is cash and cash equivalents divided by current liabilities. This tests the company's liquidity based on available cash without the need to collect receivables. Our sample company's cash ratio in 2024 is 0.1 times. If we compare it to its past, we can see that this is its normal level. If we compare it to its competitors, we can see that the first competitor has a cash ratio of 0.2 times, and its second competitor also has a 0.2 times ratio. Through this comparison, we can see that the low cash ratio is their normal level. However, our sample company has the lowest ratio, which means that it has the lowest cash pile. So what's our judgment? Our sample company has a healthy current ratio. Its quick ratio is at par with the previous year, and its cash ratio showed a slight improvement in the current year. Against its competitors, our sample company is the most liquid based on current ratio, but its competitors have better cash pile in terms of quick ratio and cash ratio. But why is this still good despite having ratios below 1? Isn't that a red flag? This is an example where industry and the nature of business matters. Property developers, such as our examples, carry high-value real estate inventories and receivables from installment sales, which makes up a significant portion of their current assets. When we take those away for analysis, it can make figures look terrible. Context matters. So what are the key takeaways here? The rule of thumb is, a low ratio is bad, but a very high ratio is not good either. We want a healthy and normal level. To determine what is normal, we need to understand the company's business nature, the ratio level of other businesses in the same industry, and the company's own past performance. Now let's move to another balance sheet angle called solvency. This answers the question, can it survive its debts? These are ratios that will look into the overall debt level of the company to see if it has a healthy financial foundation or if it is too dependent on debt. But first, let's review what long-term debts are. Long-term debts are borrowings and obligations of the company that are due in the next year and beyond. They are debts that will be paid later, therefore, debt management is crucial. The most common and easy-to-use solvency ratios are debt to equity and interest coverage. Debt to equity shows how much the company's operations are financed by debts versus funds put in for capital. A ratio higher than 1 means heavy reliance on debts, while a ratio lower than 1 means the company relies on its own capital. Interest coverage shows how many times its earnings can cover interest payments. A higher number means it is easy for the company to pay off interest, while a low number could indicate some struggle. The formula for debt-to-equity ratio is total debts divided by total equity. Our sample company's debt-to-equity ratio in 2024 is 1.6 times. This means debt is 1.6 times higher than equity, therefore, debt is high. The next thing we want to know is if this level is normal for the company. If we look to the past, we will see that its 2023 and 2022 ratio is 1.7 times. So this debt-to-equity level looks normal for the company. But what if we compare it to competitors? The first competitor has a ratio of 1.3 times. Its debt level is lower than our sample company. However, the second competitor has a ratio of 0.6 times. Not only does this competitor have the lowest debt level among the three, but it has a low debt level in general. But there is another computation for debt-to-equity ratio. Instead of using total liabilities, it only takes interest-bearing debts into account. Interest-bearing debts are obligations that carry interest payments. They are short-term and long-term loans and borrowings, and depending on the analyst, also includes lease liabilities. Let's see how the ratios will change if we only use interest-bearing debts. Our sample company's DE ratio is now at 0.8 times, and the ratio looks better because it is now below 1. Its first competitor also shows better ratio at 0.9 times, while its second competitor is even lower at 0.3 times. But as an investor, which one should you use? Well, using total liabilities is the conservative approach, and it focuses on solvency by taking all company obligations into consideration. Using total interest-bearing debts is the most commonly used approach, but it focuses on leverage by only looking into the company's borrowings. Now let's move to interest coverage ratio. The formula is earnings before interest and tax divided by interest expense. If the income statement does not itemize EBIT, you can calculate this by adding back interest expense to income before tax. Our sample company's interest coverage ratio in 2024 is 3.7 times. This means earnings is about 4 times larger than interest expense. Thus, the company does not have difficulty absorbing interest payments. Based on the company's past, this level looks like its normal level. If we compare it to others, the first competitor has a higher interest coverage at 5.1 times, but its second competitor has an even higher interest coverage at 8.5 times. As far as this ratio is concerned, the higher the ratio, the better. We've covered the basic solvency ratios, debt to equity and interest coverage. But there's another useful metric for solvency called net debt or net cash. This adjusts the company's debts with available cash. A company could look heavily indebted on the balance sheet, but if it is keeping a huge chunk of cash, its solvency is stronger, while a high debt level and low cash is riskier. A negative number means the company is net cash, while a positive number means the company is net debt. The formula for net debt is total interest-bearing debts minus cash and cash equivalents. In 2024, our sample company was $279 billion net debt, 8% higher than the previous year. Now let's compare it to its competitors. Its first competitor has a larger net debt at $372 billion, while its second competitor has the lowest net debt at $46 billion. So what's our verdict here? Our sample company's debt to equity is higher than 1, which means indebtedness is high, and net debt seconds this. But the company has an interest coverage at 4 times, which means they are not struggling to pay interest from its earnings. If we compare it to its 2023 figures, we could assume that this is the normal debt level of the company. But what about against competitors? For debt to equity and net debt, the lower, the better. But for interest coverage, the higher, the better. So it appears that the second competitor has better ratios. So does this mean the second competitor is the better company? Not yet. We need context behind the numbers. Why does it have huge debt? And why is it increasing every year? Is it because it is aggressively growing? Or is it because it can't sustain its operations? It is also important to understand the industry. Our samples belong to an industry that requires huge upfront spending for projects, so it is quite normal for them to go into big debts, with the expectation that high revenues in the future could eventually cover those debts. Debt for business growth is good if properly managed, but debt for operations is not a good sign. Lastly, banks and creditors require companies to maintain certain ratios. A company that continuously meets those requirements adds another layer of assurance that they are capable of managing their debts. Now let's move to the last balance sheet angle, efficiency. This answers the question, is the company making the most of what it has? These are ratios that measure how effectively a company uses its resources. We will look into the company's ability to effectively utilize its assets and inventories, plus a look into inventory days. Asset turnover tells us how effectively a company generates sales from its assets, so the higher the ratio, the better. Inventory turnover tells how many times in a year a company sells its inventory. Generally, high is good, but too high could strain inventory replenishment. From inventory turnover, days in inventory can be calculated to show how long inventory is usually turned to sales. But there are 2 more basic efficiency ratios: accounts receivable turnover and accounts payable turnover. AR turnover shows how quickly sales made on credit are collected and turned to cash. A P turnover shows how fast the company pays its purchases made on credit. But here's the slight problem with these 2. Most companies do not itemize credit sales and credit purchases in their financial reports, making it hard for an individual investor to calculate these ratios. So for now, we will skip these 2. Let's start with asset turnover. The formula is net sales divided by average total assets. Our sample company's asset turnover in 2024 is 0.9 times. This means that for every peso of asset, the company is able to generate 90 cents in sales. Is this good? If we look into its 2023 turnover, we can see the same turnover rate, indicating that this could be the normal level for the company. But what if we compare it to other companies within the industry? Let's see. Against others, the asset turnover ranges from 0.9 times to 1.4 times. Remember that this ratio tells us how much is squeezed from assets to turn them to sales, so the more peso sales generated for 1 peso asset, the better. Therefore, the first competitor has the best asset turnover in 2024. But what if we test our sample company against the average? The average for all 5 companies in 2024 is 1.1 times. This shows that our sample company's asset turnover is below our sample industry's average. The next ratio is inventory turnover. The formula is cost of sales divided by average inventory. Our sample company's inventory turnover in 2024 is 2.7 times, which is on the same level as its 2023 turnover. This means that the company's inventories are sold and replaced 2 to 3 times per year. But what if we want to see this in number of days? We can turn this into days by dividing inventory turnover ratio to 365. Our sample company's inventory days is 133, which means it takes them 133 days to sell what they've produced. That's about 4 months. Is that too long? Let's see how the others are doing. Inventory turnover ratios range from 2.7 to 6.4 times, with our sample company ranking at the lower end of the range. In terms of days in inventory, the fourth competitor has the lowest days in inventory at 57, while our sample company has the longest. This means that other manufacturing companies are able to move their inventory much quicker than our sample company. But what if we compare it to our sample industry average? The average turnover is 4.7 times and inventory days is 88. This means our sample company's 2.7 inventory turnover and 133 days in inventory is quite slow compared to the industry average. So what's our judgment for our sample company's efficiency? If we analyze the company on its own and compare it to the previous year, the company has neither improved nor declined. They were able to maintain the same level of efficiency. But the question is their normal efficiency level good or bad? Here's where industry comparison matters. We have compared our sample company to 4 other companies in the industry plus their average, and we can see that in terms of efficiency, our sample company is lagging. In terms of inventory management, 3 companies are higher than the average turnover rate and are better than our sample. If we talk about inventory days, the same 3 companies have lower days than the average, and they are faster in moving inventory than our sample. And lastly, in asset utilization, 2 companies are higher than the average, and also better than our sample company. So does this mean that our sample company is terrible? If we just look at the numbers, it is. However, we always have to look beyond the numbers. Context matters. Different industries have their own level for what is normal. A property developer, for example, could have a much lower turnover compared to food and beverage manufacturers, and that is still normal. But even within the same industry, companies could carry different kinds of inventory, so understanding the business of the company is also important. A company that produces goods with a longer shelf life could afford a lower turnover compared to quickly perishable goods. A high ratio is good, but management is better, especially with inventory. We don't want a company with very low turnover, which could point to overproduction, nor a company with a very high turnover, but frequently experiences stockouts. In the previous video, we covered how to check if a company's profits are good, and here we've covered the basic tests to assess a company's balance sheet strength. Computations are the easiest part of financial analysis. It is determining whether the numbers are good or bad is what makes it challenging. There are general benchmarks, but context is still important. Analysis is a skill, and learning to decide whether a company is good or bad takes time, practice, and exposure. Remember the tips. Get first-hand knowledge by doing your own comparisons against the company's past. Then do a comparison against other companies in the industry to get a view of what is normal. And read what the professionals are saying, but take what they say with a grain of salt, because you may not know the full context of their analysis. In our next video, we will move out of sole financial statements analysis and add an external aspect, which is the stock market. We will cover basic valuation ratios to help us understand how the market is valuing the company. Please keep in mind that the companies used in this video are for illustration purposes only. This is not an investing advice. Thank you for watching. If you liked this video, please like or subscribe to my page and channel. See you on the next one.